All right, welcome to History of Money. Professor Barth here, history professor at Arizona State University. We are moving right along ahead with our study of American monetary history and a history of the U.S. dollar and of U.S. banking. Today, for Lecture 24, we're going to take a look at the independent treasury system and the free banking era in antebellum America. Now, antebellum means before the war. What war are we talking about? Obviously, the Civil War. The Civil War. So in the decades prior to Civil War, what does a banking system look like? And you'll recall from Lecture 23, the Bank War. Andrew Jackson took down the Bank of the United States. Epic event in U.S. history, and especially in U.S. monetary history. Jackson slays the head of the many-headed monster, and then removes the federal deposits, bleeding the bank dry, and from 1836 until 1913, no central bank in the country. Well, as a result of Jackson and Jacksonian politics and democracy, the Democratic Party did very, very well in the antebellum period. 6 of 9 presidents between 1828 and 1856, 6 of 9 presidents were Democrat. 13 of 15 Congresses were Democrat. And then when you finally had an exception where the Whigs controlled Congress and the White House, the Whig president, William Henry Harrison, caught pneumonia and died, and a bill for essentially a third bank of the United States was vetoed by President John Tyler. So Democratic dominance of Congress and the White House is going to translate to a monetary system, to a banking system that aligned with the Democratic vision for how the nation's finances ought to be structured. First of all, in this antebellum period, New York City emerges as the great financial center in the United States. The Bank of the United States, prior to its dissolution, was headquartered in Philadelphia. With the closing down of the Bank of the United States, now all of a sudden New York City is the financial capital of the U.S. That's where the biggest banks are. Those are the banks that emerge in the post-Bank of the United States era as the greatest, with the most capital. And New York City, to this day, is the financial capital of the U.S. and arguably of the world, side by side with London. So New York City benefits from this. Now, you'll recall from Lecture 23, the Panic of 1837 occurred. And the panic taught the federal government, Martin Van Buren happened to be president at the time, that it was a mistake to lodge Treasury deposits, federal funds, in the state banks. As state banks, especially out west, were reckless with the money. They mismanaged the money. And so after the Panic of 1837, there was a movement, and it was opposed by the state banks and opposed by the Whig Party, but it eventually passes Congress and receives the president's signature, President Polk to be specific, for an independent treasury system to replace the system of pet banks that had arguably caused the panic in 1837. This law, actually the first independent treasury law, was passed under Martin Van Buren, but then the Whigs quickly repealed it in 1840. But it was resurrected under President Polk in 1846. But the independent treasury system replaces the system of pet banks, and the federal government held its deposits, held its funds in treasury vaults, in the vaults of the U.S. Treasury or in sub-treasury vaults located throughout the United States. And they would keep their deposits in gold and silver, held directly by the U.S. Treasury or in sub-treasuries in New York and Philadelphia and in Tennessee, all across the Union. The U.S. Treasury had sub-treasuries, and that's where all revenue was stored, and also where government expenses were paid out. And the Treasury received revenue and paid out expenses in gold and silver, no longer lodging its funds in the banking system. From 1846 until the Civil War, this is the only period in U.S. history where the federal government was just completely severed from any involvement whatsoever in the banking system. There's no federal bank, there's no federal charters for any banks, and the U.S. and the Treasury doesn't even deposit its funds in a bank. Nor are there any federal regulations of the banks. There's no involvement whatsoever between the federal government and the banking system for this 15-year period preceding the Civil War. Well, that begs the question. Where are the banks? Who's in charge of the banks? And if not the federal government, then what? And the answer to that question is the state governments. The state governments. Banking doesn't go away after the bank war. Now, you'll recall there were different groups, different interest groups within the anti-Bank of the United States movement. One of those was hard money, which opposed all fractional reserve banking. Andrew Jackson was in that group, James K. Polk was in that group, Thomas Hart Benton was in that group. But then you had another group called free banking. And free banking wholeheartedly embraced fractional reserve banking, didn't have any problem with it. What they didn't like were the exclusive privileges held by monopoly banks who had special inside connections in government and won out different favors and privileges within government. They wanted a completely laissez-faire, just open anybody banking system. And this was called free banking. Free banking wins out. The hard money dream of not having fractional reserve banking slowly dies away. Free banking takes charge in the antebellum period. Look at this. We've seen these numbers already up to 1818. By 1837, there were 712 banks in the United States. And of course, these are all state-chartered banks. All state-chartered banks. So that, and each one issued their own banknote. So there's the Mechanics Bank in Memphis, a $10 bill. Some of these notes, by the way, are really, really cool. In my view, this period of U.S. history has the best notes. I love antebellum American notes. They're just beautiful pieces of work. Here's a Charleston, South Carolina Farmers and Exchange Bank $5 note. But look at this, 712 banks in 1837. Look at that, by 1860, 1,600 banks by the eve of the Civil War. 1,600 banks, the bulk of which are issuing banknotes, their own banknotes. That's wild. That's a lot of banks. As you can see, the hard money position was not victorious, right? The hard money system was not victorious. Allegheny County Bank. And all these different banks. There's a Stonington Bank from the state of Connecticut. Look at the whale. I told you, these notes are awesome. These notes are awesome. Look at all those banks. Here's some more. Bank, state of Indiana. A bank $50 note issued in the Republic of Texas. So what is free banking? Now, free banking was not adopted in every state. Remember, it's all done by state. The federal government doesn't get involved in banking at all. So it's not, the federal government doesn't pass a single law that applies throughout the entire union and says, all right, we're going to have free banking. Banking will be opened up to anybody who can start their own bank. No, it had to be done state by state. New York was one of the first states to adopt free banking. They did so in 1837, or possibly 1838. New York adopted free banking, and then very quickly it spread throughout many states in the Union. Not every state, but most states, actually. And under free banking, there were no special banking charters. So prior to free banking, you had to maneuver within the state government and make different allies within the state legislature and try to basically lobby for a bank charter. And if you were lucky, if you knew the right people, maybe if you paid a little bribe here and there, you might be able to get a bank charter. Now, under free banking, there are no special charters. Instead, there's just a basic rule, basic legal regulations, usually in the form of a minimum capital requirement. I'll get into some of the basic legal regulations in a moment. But anybody who met those basic minimum requirements, those basic legal regulations, they had the right to open up a bank and to issue banknotes, redeemable on demand in specie, in coin. Anyone who wanted to. And the comparison here was, well, if you want to start a butcher shop, or if you want to start your own restaurant, or your own whatever, barber shop, do you need permission from the government? No, you just do it. You do it, and you're successful or you fail, and that's just that. And proponents of free banking argued, if you can establish those sort of businesses, why not be able to establish a bank? And let's let that open as well. And so anybody could establish a bank, and that's one of the reasons why you have 1,600 banks in the U.S., many of them issuing banknotes by 1860. This was the most decentralized and laissez-faire banking era in U.S. history, bar none. We haven't had anything like it before or since, but it was pretty much just an open field, free game. Now, there were some regulations, and the regulations were actually quite important. All right. There's a Wild West type atmosphere about it, but it's not completely Wild West, and actually it was more organized and less chaotic than I think one might initially think. But let's look at some of these minimum regulations that operated. First of all, you had to have minimum capital requirements, and the minimum capital requirement depended on the state. Each state had a different requirement. But, if you had just $1,000, you couldn't start a bank. But if you had maybe $30,000 or $40,000 capital base, you could start a bank. But you had to have a minimum capital requirement, so that you didn't just have totally just fly-by-night mom and pop banks popping up. Although in some states, as we'll see in a moment, you kind of did. But in theory, you're not really going to have that. There's some minimum capital requirements. You have to have some sort of real base of money to operate on. And then if you meet that requirement, then you are free to go ahead. Another regulation, there was no interstate branch banking. So if you were a bank in New York, you could only branch in New York. If you were a bank headquartered in Philadelphia, you could only branch in Pennsylvania, right, and so on. And in some states, they actually prevented intrastate branches, meaning you couldn't even branch within your own state. But no interstate branch banking. Like today, you'll find Wells Fargo branches in multiple states, probably every state in the union, Bank of America, MidFirst Bank, the one I bank with, they have branches in Colorado and Arizona and in a few other states. Not so in this era. Another regulation, and you may not think much of it, but this is a regulation. All banknotes were redeemable on demand in gold or silver coin. This operated as a check on the bank. Because at any time, the note holder had the legal obligation, or the legal right, and the bank had the legal obligation to redeem those notes in gold and silver coin. And if they couldn't meet that demand, then they went bankrupt. So that was a check, a regulation on what? On how many notes, on how much paper currency the bank could issue. Moreover, I can't remember if I have this in a later slide, so if I do, I'll just say it now. There were investors, or excuse me, inspectors who worked for the state government who would visit the bank and inspect just their business, audit their books, check to see if that they're not doing anything fraudulent. And so you did have bank inspectors working on behalf of the state government just to kind of oversee things and make sure nothing too fishy is going on. So in this era, you still got coin, still got gold and silver coin. We got a whole lot of banknotes. Another, and probably the most important regulation, was that all banknotes in the free banking era were secured by state bonds. Secured by state bonds. Now let me explain what that means. Every banknote that the bank created, printed, emitted, every dollar banknote had to be backed by an equivalent sum of state bonds. Okay, state bonds, debt issued by the state government, purchased by the bank. Now, what's the point of that? Why are these banknotes secured by state bonds? Why is that regulation important? Well, if the bank ever did go bankrupt, okay, so this is one of the checks. All banknotes must be redeemable in gold and silver coin. Well, what if they're still irresponsible and the bank goes under? Do you lose everything? Do the note holders completely lose out and now the note in their hand is completely worthless and they can't get anything for it? No. Because if the bank went bankrupt, the state was then able to redeem the notes of all the note holders because each note was backed by an equivalent sum of state bonds. So what the bank had to do, and here let me this might be an easier way to explain it. Here's a balance sheet. All right? The liabilities, we have $20,000 of bank notes for this bank and $80,000 in demand deposits. All right? So that's $100,000 in demand obligations that the bank must account for. This bank chooses a 15% reserve ratio. Not a bad ratio, 15%. So what does that mean? They have $15,000 of specie in the vault. Okay? So at any time, note holders or depositors can come to the bank and they can get coin. And it's a 15% reserve ratio. The same bank also, however, has state bonds as part of their assets. And in fact, they are required by law. See, because they have $20,000 of banknotes, the law required them to also have $20,000 of state bonds. And to enforce this regulation, those state bonds actually had to be lodged in the state government. So each bank that printed banknotes had to buy an equivalent in state bonds and then lodge it with the state government. So that, let's say there's a bank run, and very quickly this disappears. All right? Do the people who have these banknotes completely lose out? No. What happens? The bank goes under, and the holders of this banknote can then go to the state government and get that equivalent in specie because the state government has these bonds that the bank lodged with the state government and can redeem those banknotes. Okay? And the advantage here for the bank is that they can utilize that 20,000, these state bonds, the bank actually receives a interest on. And so the bank, there's a yield. Bonds always have a certain yield. And so the bank is able to secure these notes and make a little bit of money too. It's an asset. Bonds usually don't perform aren't the best performing asset, but they're a pretty stable asset. And so that was there as a security in case the bank went under. And it happened a few times. The bank would go under, the note holder could go to the state government. The state government will take the bonds that bank had lodged with it, sell the bonds, take the specie from that sale, and then redeem the notes. Okay, this gave added security to all banknotes because they were secured by state bonds. So you look at this bank here. This is a New York bank, the St. Nicholas Bank. St. Nicholas Bank, $5. You'll notice the language here. Will pay $5 to bearer on demand. So if you have this note, anytime you could go to St. Nicholas Bank and receive $5 silver. Oh, but what if St. Nicholas Bank goes under? What if there's a run on St. Nicholas Bank and St. Nicholas Bank dissolves? Are you completely out of luck? No. You can go to the state of New York. Why? Because this $5 note is, you see it here, secured by pledge of public stocks. Secured by pledge of public stocks. In other words, secured by state bonds. And this gave some added security to the notes. I hope that makes sense. I think it does probably, but there may be a few people out there who are a little confused. If you don't totally get it, understand that there is some added security to these notes that gives the note holder a little bit more safety in holding this note. Look at this, the St. Nicholas Bank. There's St. Nicholas, the reindeer and everything. Wow. So all these notes. Now this looks chaotic, okay? When I tell students, they're like, wait, what? There's hundreds and hundreds of notes? Yeah, there were hundreds and hundreds of notes. But it was a little less chaotic than you would think, okay? First of all, these notes are generally circulating within a certain radius, okay? And outside that radius, they're not really entering circulation, okay? So if you live in anywhere, all right, you're not coming across hundreds of different banknotes. You're more than likely coming across, well, it depends on where you are. If you're in Philadelphia or New York, you might encounter a dozen different type of banknotes. If you're in a smaller town, you may just encounter a few types of banknotes, and you became familiar with those banknotes. Moreover, they're all denominated in dollars, and they're all secured by state bonds, by the public stocks. And so, by consequence, with some exceptions and some key exceptions, most banknotes circulated at par. Most banknotes in the free banking era circulated at par. Your average American living in New York or Philadelphia or in Charleston did not really discriminate much. They got a banknote, they saw it, they probably had seen this bank before. For the most part, they trusted that this was a $5 note and would circulate it at $5. Okay? There are some exceptions. If you're living in New York and all of a sudden you come across a note from Indiana, okay, you're immediately red flags are going up. What's this Indiana note doing in New York? You're going to be unsure about that note, and you're probably not going to want to take it. Notes from further away were more likely to circulate at a discount. And actually, there were banknote detectors, these monthly journals that gave the current rates for all these different notes across the country. So if you were a merchant especially, or if you were a shopkeeper, and all sorts of notes are going through your shop, you might subscribe to one of these journals, and you would see, okay, such and such banknote, it circulates at par, I don't have anything to worry about. This banknote, not so good. I'll take it, but I'll only take it at a discount. It's a $5 note, I'll take it for $3. Okay, that wasn't terribly uncommon. All right, it happened. And it especially happened for so-called wildcat banks. And these wildcat banks really gave the free banking era a bad name, and not for totally wrong reasons either. Wildcat banks were a problem, especially out west. A wildcat bank was a bank that really didn't have the funds. Very few funds, and was set up on fraudulent pretenses or fraudulent intentions. The founders of some of these wildcat banks had very, very little intention of actually ever redeeming their notes. And many of them would set up their bank office purposefully way out in the country, okay, out where the wildcats live. That's why they're called wildcat banks. Here was an infamous wildcat bank, the Bank of Brest in Michigan, so a western state. It set up its offices way out where the wildcats were, so that people would not redeem the notes. It was intentionally that way. And these notes, very quickly, once people figured it out, these notes circulated at a heavy discount. So you come across this banknote. Now, some people got suckered into it and would accept it at $2. And some people got ripped off. You get ripped off. You go, a $2 note, I'll take it. And then you found out that actually this thing's worth a quarter at best. Very few people are going to take this note. Like I said, this tended to be a problem out west. And in the more established eastern states, not really much of a problem. Most banknotes still circulate at par, but you still have this problem of wildcat banks and of banknotes kind of going far and wide and circulating at a discount, and that sowed some confusion into the system. You actually had a new profession, money brokers, who went around collecting these notes that were circulating at a discount, bought them up at a depreciated price, and then traveled hundreds of miles back to that bank's headquarters and demanded redemption. And at that point, let's say you're a bank kind of far out west, and some guy from New York comes in with a stack full of your notes, demanding coin. Are you going to have it? You may not, and that's when you go under. And some of these banks did indeed go under. And some of them, like I said, were fraudulent. There were some of these banks out west who, when the state inspector came by to inspect their vaults to make sure that they weren't operating fraudulently, they would have barrels of nails, and on the top they would have some gold coins, and they would try to pass that off as having, they've got a big barrel of gold here. Not really. But like I said, these are the exception more than rule. For the most part, the system actually functioned a bit more smoothly than you would think. And there were surprisingly few complaints about it back in the 1840s and the 1850s. Some of these banks, moreover, joined associations in order to make the system work even more uniformly. In New York, for example, the first clearinghouse was founded in the early 1850s, and New York banks came together and voluntarily agreed to come together as an association to accept each other's notes at par. One bank would agree if someone else came into their bank with the other bank's notes, they would take that bank's notes at par and vice versa. And then at a certain date, maybe quarterly, the banks would all come together and clear their balances. This helped to establish a relatively uniform system despite the highly decentralized nature of banking in places like New York. And this is a picture of the clearinghouse. All these different banks coming together and clearing their balances so that, let's say you have these three banks in New York, Bank X, Bank Y, Bank Z. Bank X happened to accepted the notes of Bank Y and Z, and Bank Y accepted the notes of X and Z, and Bank Z accepted the notes of X and Y. And they all end up having each other's notes. They would come together and clear their balances so that if you did the math, Bank Y, Bank X has more of Y's notes than Bank Y has of X's notes, and so Bank Y owes Bank X $200 in coin, and so on. But this helped to create somewhat of a uniform system where the banks had an interest in associating together and accepting each other's notes because that helped their own business. So, in short, it appears chaotic, and in some ways it was a little chaotic, but it was actually remarkably effective, all things considered. And the country was going through this market revolution. Free banking helped fuel the market revolution. I want to look at this one map here. Railroads. Railroads were capital-intensive projects. You needed a lot of credit to build a railroad. Free banking financed the building of the nation's railroads in the antebellum period. In the red, you see the railroads that existed in 1850, and in purple, the railroads that were built during the 1850s. And look at that. That was all financed by the free banking system. And so, there is that caricature out there of these, wildcat banks and sort of an anarchic banking system. But actually, I'm of the opinion that the system worked a little better than has often been given credit for. Well, anyway, we're going to stop it there. And for the next lecture, lecture 25, we're going to take a look at the American Civil War, because in 1861, of course, after the election of President Abraham Lincoln, war erupts, and finance and paper currency. That is a subject we'll look at next time during the American Civil War. I will see you there. So long. Bye. Hey, y'all. There's just one more point I wanted to make about the free banking era and forgot to do so. There's another benefit to the free banking system that I don't think gets enough attention. And that is, again, it's decentralization. This was such a decentralized banking system. There are some economists who see that as a negative, who like a centralized banking system. But if you look at this era, the money power, those in control of the banking system, it was not so concentrated. It was not so concentrated in just a few oligarchic hands and just a few oligarchic institutions. It was relatively dispersed across the country. And does that cause, a little less uniformity, or even a bit less uniformity than you'll see in subsequent periods? Yes, but again, the money, the control over the banking system wasn't so heavily centralized. And I think especially coming from our perspective today, where the money power is so concentrated in just a few hands, it's undeniable, especially after 2008. Coming from that vantage point, there's something remarkably refreshing about this system. And just looking at all the different banks and banknotes, and because you really just don't see the big banks that you'll see in subsequent periods. And it's true, some banks were bigger than others, no doubt. But again, there's just something refreshing and humble about banking in this period that it's difficult not to be drawn to a bit. And so I wanted to add that just because I think that's another thing that could be easy to miss, but is an important element, I think, of the system that is unique to this period that we don't really see in future periods. Anyway, I'll leave it at that. Look forward to seeing you for the discussion on the Civil War. Bye.